Hello, trade pros, and welcome to lesson 1 of order flow basics. This is Sarah from Trade Pro Academy. And before we get started, why don't we play that intro? So this order flow basics course is designed by myself, and it is specifically for YouTube. Now, we do have an order flow course available on our website that is much more comprehensive. However, this course is just for you guys, our subscribers. So before you get started, why don't you hit that like button and subscribe so you can be the first to access every new course that comes available on YouTube. So let's begin. This is a 3-part mini course series. And who is this course for? It's for new options traders. And it's for options traders who are new to using options order flow. So today we're going to talk about what is order flow, the advantages, disadvantages, sweeps, blocks, and splits, date of expiration, and the strike price and spot price. So what is order flow? Order flow is a term used to describe options data, which is tied to the concept of following orders executed by smart money. So in other words, you are following the cash. And the term smart money is used to describe orders placed by institutional traders, prop firms, and/or market makers. So that is the type of order flow we are looking to follow when we're observing orders coming in through the tape. Order flow is similar to reading the tape, which is a method used by stock traders in order to follow share volume and activity. Retail traders have access to various order flow programs such as Flow Algo, Cheddar Flow, and Trade Alert. Options order flow reveals the following: the position of the buyer or seller. So was it a call or a put? And was it at the bid or the ask? The ticker, the strike price, the quantity of contracts, the type of order. So was it a sweep, a split, or a block? And the time the order was placed, and the spot the order was placed. So advantages of order flow. Order flow allows traders to see where institutions are investing their money. This can be used to execute momentum plays, swings, leaps, etc. And order flow can reveal future direction of a security, sector, ETF, and/or index. So many institutional traders choose to primarily rely on order flow analytics over technical analysis using charts. Now, this may be a surprise to many, especially retail traders. However, cash and volume is what ultimately moves a security, and it's therefore key to discern where big money is putting their cash. Order flow reveals options order details, which paint a picture of what the trader's objective is. Now, there are also disadvantages of order flow. So many of the options order flow programs available on the market do not paint the full picture. And this is particularly true for programs that are available for retail traders. So all order flow programs run on assumptions using the bid and ask price. So we don't know for sure if contracts were sold or bought, for example. Order flow does not show us when a position is sold, only when it is bought. So we have to sell our positions at our own discretion, except if you know a few little tricks like I do, which may be revealed in a future trade alert video. So unless trained, A large number of traders do not know how to capitalize on all of the order flow tools available to them. This is a big reason why we actually offer private training in order flow at TRADEPRO Academy. So what are sweeps, blocks, and splits? Sweeps are multi-exchange sweep to fill orders. So sweeps are considered an aggressive and directional position. So if we see a sweep come in, for example, on AMD, and it's at the ask, or above the ask, that is telling us that this order was bought and it was bought as fast as possible. It's the most aggressive type of order there is. So splits, they're similar to a sweep order, except splits are executed on a single exchange. Now, splits are still considered aggressive. However, they're not as aggressive as a sweep, as they don't imply the same sense of urgency. And last but not least, block orders. So a block order is a large privately negotiated order executed by institutions with major financial backing. So the date of expiration. So theoretically, the date of expiration tells us that between the date of purchase and the date of expiration, an institutional trader believes that the stock will hit its strike price. For example, this order is telling us that between November 24th, 2020, so this was the day the order was executed, and December 31st, 2020, the option contract expiration date, Apple will hit $123 per share. So all options contracts have an expiry date. The longer at the expiry date, the higher premium you pay. And this is because you are paying for more time for your contract strike price to be hit. Additionally, options contracts with more time value have lower theta, the daily rate of decay in your option contract's time value. So in contrast, option contracts with a short dated expiry cost less, because your theta, or time decay, is higher and will continue to subtract value from your options contract at a faster rate at a greater negative value than an options contract with a long dated expiry. So with that being said, why would anyone buy a contract with a short expiry date? Well, there's cheaper premium. So as stated on the previous slide, short dated contracts have cheaper premiums than long dated contracts. There's more leverage. Short dated contracts tend to have more leverage, and this is for two reasons. Because of the cheaper premium paid, meaning our break-even point on our contract is not as high. And because short dated option contracts have higher gamma, which measures the rate of change in your options delta. Gamma compounds in value by each day. So this means if your contract has higher gamma, it'll keep adding more value to your contract every day your options contract gets closer to being at the money or in the money. And this will ultimately exceed your theta decay. So the strike price and spot price. What does an option strike price and spot price tell us? Well, similar to the date of expiration, an option contract strike price tells us the theoretical price of what the underlying security will be before or at the date of expiration. So the spot price tells us how much the underlying was at the time the contract order was executed. When following order flow, when possible, we want to have the same spot price and strike price. By executing the order at the same spot price, we can likely pay the same premium as the institutional buyer, or sometimes even a little bit less. So that's the end of Lesson 1, Order Flow Basics. Please hit that like and subscribe button. Still have 2 more lessons, and those will be coming out very soon. You want to be able to see that as soon as possible. We also have tons of other great video series that are coming, so it's definitely worth subscribing to our channel. And you can also follow me at TradePro Flow on Twitter for real-time order flow alerts. I tweet here a few times a day, and I pay very close attention to the spot price, the strike price, the time the order is executed. I reveal all those details. I also post the chart. So if you're looking for trades, that's where you can find them. And you can also trade live with us at community.tradeproacademy.com. This is our free public trading channel, and we would love to see all of you in there. Have a great day, guys, and see you in lesson 2.